after your last talk you gave, you said you didn't want too many nutters to turn up.
So too many?
Well, you said for your last talk you didn't want too many nutters to turn up. Not to advertise it too broadly.
See if that works. Can I? Oh, no. Let's see.
Only the residents.
Can I say something?
Hello?
I can hear you. Good. Okay, that works. I wonder why they closed it. I would have thought that there would be fire regulations that would require them to have that door still there.
In case of emergency, break glass.
Yes, they don't. You need a fairly.
Student or?
Well, yes.
Michael, let me know if I'm talking too fast again. I was horrified when I looked at the recording of the last one.
Okay, so we are not in the University of Sydney that start their seminar today, as I found out today. We are here at UWA where we start at 2 p.m.
Unless you're late. Unless Thomas is late.
Well, unless I'm late, but I came in just in time last time. Today we have Alistair Mees giving us a presentation on volatility. You can read the title here. The nice thing is it is really appropriate to have this talk on the due date of Shannon because, as Dave pointed out, one part of the talk is about Shannon's demon. I don't know whether you put that there on purpose.
I didn't choose the day, you chose the day. but yeah, Shannon means wise storyteller, apparently in both Scottish and Irish Gaelic, so I thought that was appropriate for them.
Okay.
Right.
Thank you, Alistair.
Okay, thank you. So, yes, there's a pun in the title that will only be apparent to people who are sufficiently old, and you can ask around if you want to know about the argot of the flower power generation. So, no, it's not going to move. Okay, we'll try it this way. Sorry about that. All right. This is the first two parts of a syllogism. Remember, syllogism, all men are mortal. Socrates is a man, therefore Socrates is immortal. We're going to look at what happens over here. Stock market is made of numbers. Everyone here is good at numbers. So we'll start off with something simple. So a game, just flip a coin, and you pay $1 up front, and the casino gives you $1.40 back if you win, but only gives you 30 cents back if you lose. Now the mean of that is 1.05. You should make 5 cents every time. People will flock to this casino. And it certainly looks as if the casino is going to go bankrupt pretty quickly. So here's the simulation, and this space bar still doesn't work. Okay, just a couple of sample paths. I'm using a log vertical scale just really because I'm choosing totally artificial numbers to kind of drive the point home and make things look convincing. So you realize that if you started off with $1,000 in this casino after, I don't know what, about 20 steps, you're down to $100. And so just bear in mind that something that doesn't look too terrible on a log scale can actually be pretty bad for you if we're looking at money. So here we are. I've run this with thousands of sample paths, but the macOS preview explodes if you try to give it a big PDF file. So this is just 64, and you can see that, well, some people win, but a lot of people lose as well. And these things there, again, they're down to 10 to the minus 5 of what, so something down here, down to not much better than a millionth of what they started with. So in a realistic game, anyone that ever went below about here wouldn't ever carry on any further. I haven't bothered to simulate that because I'm just trying to make an obvious point. I mean, I guess everyone here knows, well, yeah, of course, it's not the arithmetic mean that matters, it's the geometric mean, because you're keeping on repeating. And the geometric mean of this, anyone who lived in the days of the old measures and knew the 14 times table will immediately tell you that 0.7 times 1.4 is 0.98, so the square root's of course 0.99. So the geometric mean is less than 1. In this particular case, we've got 2/3 of the players don't make money. The median gain is 0. The mean gain was quite high, 3,500. But the casino is in trouble because it paid out well over $200,000 and it only received $64 at the start. So it's one of these things where everybody loses except for very, very few lucky people. In this case, 1/3 of the people do all right, but yes, where am I? Yeah, I haven't got the numbers here to say how all right they do. Right, so geometric mean, of course, is less than the arithmetic mean. Here, geometric mean is about 0.99. So in fact, sample paths repeated play loses 1% on average. And this is called volatility drag by people that invest, because you discover that what looks like a very promising investment process up front can be totally screwed by volatility. I'll say a little bit more about that later. And basically from now on, because of the geometric mean, I will be looking at log prices. And here is this, although this isn't absolutely necessary to this talk, it's my favorite inequality, so you're getting it anyway. Jensen's inequality. It's actually, this is a special case of a much more general function from convexity theory, the supporting hyperplane theorem. But basically it says that if you've got a concave function, that's one that looks like that, an upside down parabola, then the function of the expectation is greater than or equal to the expectation of the function. And if the function is strictly concave, then that inequality is strict. And that happens to immediately prove that the geometric mean is less than the arithmetic mean. Here's a picture, and I've actually taken the numbers that we had already. So there's the 0.7 and the 1.4, and here's the mean at 1.05, and as we see, the mean of the log is just less than 0, whereas the log of the mean is greater than 0 because the mean is greater than 1. So we think we know what we're doing. We've got this idea of volatility drag, or the gap being called volatility drag. And with a very small amount of effort, you might convince yourself that under reasonable circumstances, the gap is about variance, about half the variance. In fact, this is, of course, very well known to anyone who ever works in stochastic differential equations. And so if we have an issue with finding the geometric mean, we could just find the variance and knock half of that off the log of the the log of the arithmetic mean. So it looks like we aren't going to be fooled. We'll just find the geometric mean if we have a game that we want to play lots of times. And so let's talk about Claude Shannon. Sometime around the 1950s, he just invented information theory out of thin air, as far as I can tell. He worked at Bell Labs, which was the research arm of Bell Telephone and Telegraph, and he was an engineer, an electrical engineer, as well as a mathematician, as well as the guy that invented information theory. And sometime in the 1950s, he gave a talk at the University of California at Berkeley on applying information theory to betting. And it's not at all clear what it was. I don't think there was anything kept particularly secret about it, but he wasn't allowed to publish because Bell Telephone didn't like people to realize that a lot of their income came from bookies. I think in a lot of cases it would have been illegal gambling. You know, a lot of things are illegal in the US. So they didn't want to pay attention to it. So what I'm going to talk about here is what I believe is a simple version of what he said, but I could be wrong. So here, this is another simple one. It's even stronger than the previous one. You bet $1, you get $2 back if you win, and 50 cents back if you lose. Now we can do the geometric mean for that in our heads, it's 1. So you shouldn't really go anywhere. And if you look at the blue and orange lines here, you can see that we aren't really going anywhere. We're losing money, but actually if you try lots of different sample paths, sometimes they'll go up, sometimes they'll go down, usually they'll dance around. And yet whatever it is that Shannon did, he's gone up by a factor of like 10, looks like about 10 to the 7 to me. Oh, I should say, since you can't see them here, I've typically chosen 256 time units. It's slightly less arbitrary than it sounds. The number of trading days in a year in most exchanges is somewhere a bit over 250. And since you quite often want to take square roots, you just call it 256. He did something magic. Now, what happens here is sometimes called volatility pumping, and yes, something I should have pointed out on this. Let's look at Shannon's wonderful result here. If you look at somewhere around 120, I should think, there's a dip, which doesn't look great, but it's largely because we were able to see the rest of it. It's actually down by, it looks to me, a factor of quite a bit worse than 10. So one of the problems with what we're talking about here, volatility pumping, is you still can find bad things happening, particularly if, as we see here with, say, the orange line, if there's kind of a trend, the orange line trend pulls things down. In spite of all that, it's still totally amazing to me that worked at all. So, as I said, some people liken this sort of thing to picking up coins on the freeway. You get run down very easily, and you make what turns out in practice to be a small amount if you don't get run down, because I've chosen numbers here for illustration, and you don't normally get such a large factor up or down. And so really the point is that the ensemble mean, which corresponds to the arithmetic average, isn't the same thing as the path mean, which is the geometric average. And there's a researcher called Ollie Peters, who might be known to people here because he has a certain amount of connection with the Santa Fe Institute. And he seems to have made a complete career out of it. You can't imagine, what I've talked about in 10 minutes He's he even has a, you know, it's not really a TV station, but it's more like a YouTube channel, and multiple books and talks all over the place. And I think the lesson to learn from that is not only that he's got plenty of chutzpah, it's that many people, things that are totally obvious to us are not necessarily obvious to the man in the street, including investors. And so, whereas I'm jealous of him getting rich and famous from doing this, and simultaneously disapproving, in the end I have to say, well, good luck to him. So the point I was saying earlier about log scales and so on, let's suppose that you have an investment that halves in value, and that quite happens overall in the stock market. Then you need 100% gain, not 50% gain, to recover. That's the sort of folklore version of volatility drag. That even although you feel that it shouldn't, you know, the volatility, you assume it's bidirectional, but nevertheless you get screwed. So there's a famous investor called Warren Buffett, whom you might know about. He's nearly 100 years old, and his buddy Charlie Munger died a few weeks ago. He was about the same age. They have a company called Berkshire Hathaway, an investment company. And I remember when I first heard about it, maybe 20 years ago, the shares were like $2,500, and they wouldn't split them. Most companies split the shares so that ordinary people can buy them, because you could only buy 100 shares at a time then. I think they're now $250,000, one share in this company. These guys know what they're doing. Well, they're pretty special, obviously, and most of us can't really take Buffett's advice to not lose money. It's kind of difficult. And so maybe there's something else we can do about it. Okay, here's one thing we could do about it. Communism. Well, actually, this is Ollie Peters gave essentially the communism version of this, and you can imagine what the right-wing comments on his blog are. Anyway, we'll do it in terms of taxation. We got these 64 players, exactly the same outcomes as before, but instead of each one playing on their own, they pool their wealth. So let's assume the government comes along, 100% wealth tax, takes it all away, then distributes it completely evenly. Universal basic income. And that's the one on the left. The volatility drag is to all intents and purposes 0, and we've got this is going back to the original 1.4, 1.7. We've essentially got 1.05 to the power 56 up there, I think. I can't do that one in my head. And you don't even need 100% wealth tax. I've done it with 50% wealth tax on the right, almost as good. Income tax, 50% income tax. Basically, you spread the wealth around. When somebody wins, they have to give some of the winnings to somebody that's been losing. And then that is called constant rebalancing. You say, I will always have a constant amount bet, and we're rebalancing between all these different people, and it works remarkably well. So basically, we're doing redistribution, reduces the variance, and this is what Shannon was doing. That was his secret there. That example I showed, I just redistributed the wealth equally, and that worked remarkably well. Well, Shannon had a colleague called Kelly. I think he was a more junior colleague, and he was maybe allowed to publish under without quite as much stuff there. And there's something called the Kelly criterion, and what he is proposing here is, let's suppose we have one bet. I mean, it might be in a lot of securities or something, but we just pretend we have one bet. We add cash to that, and we keep some money in cash, and we keep some in the investment. And he actually, his work was done in information theory, because that was very much a school of information theory, but it happens to be equivalent to doing the following. We will decide on a fraction to keep, a fraction to hold back in cash, and we'll determine that by maximizing the expectation of the log of your current total net worth, call it your wealth. This is actually very attractive because it's myopic. You don't have to predict off into the future. You just look ahead one at a time. It's easy to use, but it's also maximizing expected long-term growth. So in principle, this is the way to get rich. Oh dear, sorry. What's happened? I actually worked through it. I'm sure you can all do that in your head a lot quicker than I can, but this is the setting the derivative to 0, and it turns out that the solution is to invest about 42% in the bet and to hold back the remainder in cash. And then whenever you win money, you take some out and put it into cash to keep the percentage the same. Whenever you lose money, you take some cash and you buy more and to do the same. So here's the Kelly equivalent of our earlier graph, still 64 players playing independently. Instead of the median being 0, it's about 9, which is not totally terrible, taking your wealth up by a factor of 9 in the year, and only 12% instead of 66% people are losing money. The mean gain's way down, but although I haven't shown it here, I think the casino the casino clearly still loses money. It loses $93 times the number of players. So that casino is not going to be one that we'll discover. I'm sure they won't start doing that at the Crown along the road. Okay, now Kelly is very interesting, and it's really a straightforward idea, but there are issues. Firstly, as I pointed out earlier, things that look good in log space may not be so good in the real world, because when your investments are going bad, you don't hold on. What's more, you can't hold on. You can't bet a millionth of a cent and then wait for it to grow up geometrically. Basically, a run of losses, and you're screwed. And what people try to do for that is to maybe bet half of the Kelly amount. So they might only bet 0.2 instead of 0.4. And as you would expect, it doesn't grow as fast and it isn't quite as volatile. So there's another, just a practical issue of calculating. If we're not just doing this with one, I don't know, stock market index and perhaps a bond or something to give us the money part, then once we put in a lot of things, we've actually got a lot of probabilities to estimate and in effect an integral to do. But you can do that with Monte Carlo, and given that the system is very noisy anyway, it's probably good enough. And we are going to see that we can actually estimate something like a Kelly fraction as we go along in real time, improving it. So Kelly is actually used in practice. Warren Buffett is said to use it. Now, earlier on he said don't lose money. Well, he wouldn't be using Kelly if he'd never lost money, so I guess he does. But Ed Thorpe, who's quite famous or infamous, was using it quite a bit before that. He either got, I'm not sure whether he got his hands on Kelly's paper or whether he heard about or attended Shannon's talk, but he understood Kelly, and he was a very smart guy. He did a lot of computer simulations. I've said around 1960, I think it was in the late 50s, You know, I think that even Fortran hadn't been invented. He probably had to program it in machine code. And he did simulations of blackjack. Blackjack's a casino game that I'll say a bit about in a minute. And he went off to Las Vegas and did very well. And he managed his money using Kelly. So he would have an idea of the probability of winning in any particular round. And he had a clever way of manipulating, improving his chances, which I'll tell you about in a sec. And then he used Kelly to do this. So the early 60s, Thorpe published a book which annoyed a lot of people who were quietly using what he did, and the casinos changed the rules, which makes it more difficult. It's still possible to make money with blackjack, but it's certainly not easy. Thorpe also set up a hedge fund called Princeton Newport Partners, which did very well, and it turns out that Thorpe and Shannon were out there in the casinos also betting on roulette and playing some other card games. And this seems to have been quite a bit before Don Farmer and his merry men were doing it, which was news to me, by the way. I thought that Don was the first to do it. Anyway, here's blackjack. Here's Thorpe's book. The dealer, you get 2 cards each. The dealer has 1 card showing, and the idea is to get closer to 21 than the dealer. If you get over 21, you're bust. I went along to Las Vegas, having read the book and worked out what I should be trying to do. And I was at a table with, there were 2 people either side and the dealer opposite me. And these are, I have no idea what the cards were I was getting, but so if we imagine this was the situation I was in, I was the one in the middle. So the dealer's showing a 5. Now in blackjack, all face 10, Jack, Queen, King are all worth 10. So there's 16 10s out of 52 games in the deck. And ace can count as either 1 or 11. So we can actually go, this guy over here has got a blackjack, he's got a natural, and will be paid out, or would have been in those days paid out at 3 to 2. So if you bet $10, you get 15 back. But it actually starts from this end. And this person here started with 12. The 12 isn't much good because you're not that likely to be able to beat the dealer. So he drew and he was unlucky and got a 10. So he's bust. So I'm sitting here with a 13. I can see the other players. And I have the same dilemma as him because the dealer has a 5 here. Now, if the dealer draws a 10, he will have to hit. The dealer doesn't play for skill, plays with fixed rules. 16 or less, he has to hit, he has to take another card. And if I'd been counting the cards, I might have a good idea of whether there were more 10s than on average in the deck. And in that case, I would know to stand, in other words, not to draw a card, on the basis the dealer was probably going to go bust. And basically this is what Thorpe was doing, card counting. It's not, you don't have to memorize every card that's gone past, but I'll not get into the boring details. Thorpe did other clever stuff though. He would play illogically. He would take a clearly winning hand and keep on hitting it until it went bust. What he was doing was manipulating the content of the deck. Lots of 10s in the deck are bad for the dealer, likely to go bust. Lots of low cards in the deck are better for us. So he would do that. He would play this game. He would use the Kelly rule to manage his how much he was betting every time. I think he's a very smart guy, but I don't suppose even he could immediately tell you what the probabilities were. If I were on this, I would probably actually decide to draw if I thought there were a reasonable number of 10s. If this is all the information I had, there's already 3 10s out there, so there's only 13 10s left. And you can do a little calculation there and say, maybe I shouldn't. Anyway, I would have hit it. So what happened? I was sitting there at this table with the 3 people. They have people coming around with alcoholic drinks, which are free, or at least were in those days. Guess why, right? And none of us were accepting the alcoholic drinks, and none of us was winning very much, and none of us was losing very much. And after, I don't know what, 20 minutes or so of this, the pit boss came along and tapped the dealer on the shoulder. She went away and this guy turned up. I have never seen cards dealt as fast as that. Well, that makes it very difficult to count cards, of course, but also I have no idea where they were coming from, but none of us won a hand after that. The other guys got up and walked away. I tried playing a little bit longer to see if it would be any different, but no, I didn't win any more hands. So the reason I'm telling you this is that we have good mathematical models of things, even cases like this, which are very well understood, although complex in their way, but there can be things outside our models that will hit us. In this case, the casinos hate losing money. What they do nowadays is they deal typically from 4 decks or 8 decks of cards. They have a thing called a shoe that's in, so you can see the dealer isn't trying to peel things off. And they have a mechanical shuffling machine. So one of the other tricks that people would use if the dealer was shuffling the card, riffle shuffle, you see, oh, there's a packet of cards. I remember what's in that, and when you get to that packet, you know what's coming next. A lot of people that will go to enormous lengths. People still claim to make money on blackjack. If you play without any subtleties, but still according to certain rules, you have the house is about 1% over you, which is a whole lot better than you'll get in almost any other game. If you play really well and count cards, in principle you can be 1% ahead of the house, but the house will do things like when it looks like people are winning and they see card counters, they shuffle the deck and they all sorts of other things, and if you really win, they'll throw you out, and you're now on, you're never going to get back into that casino again. Once you spread it around, you're not getting into any other ones. It's not illegal to count cards, but it's not popular with the casinos. Anyway, okay. That's enough for the background. Really the point about this, apart from silly stories, is that we have this idea of constant rebalancing. And now we're on to another researcher in information theory, Thomas Cover. He has a very nice book with one of his colleagues, I think it's Cover and Joy, on information theory. And he came up with something he called the universal portfolio, which I also think is rather surprising. Now, everyone has at some time used zip or gzip or one of its friends to compress or decompress a file. That's done in a way that doesn't make any assumptions about the statistics. It doesn't say, hey, the letter E occurs more often, so I will have different code for that. It learns as it goes along. What Cover does is exactly that. And what this means is we're not going to have any assumptions about the statistics of the generating process or even of the individual observations. Now, of course, that means that stronger assumptions should give us better results, but at any rate, it's surprising how well you can do. What we say is we've got a portfolio of N securities, stocks, whatever, bonds, ETFs, and we do constant rebalancing for this portfolio. At least that's where we start. So just a little bit of necessary notational background. So the 1.4, 0.7 we had earlier, call that I'm just going to call that the gain multiplier. If you put in 1 unit, you get X units back. And so we just say what the I security at the end of time interval T is Xi of T. I prefer to do it in terms of time intervals because there's always an issue when you talk about a timer, is that just before you've traded or just after. So time interval, we always trade at the start and also, well, trade at the end if we're going to sell stuff. And so Kelly says, and Shannon says, put a fixed fraction into every security. We don't know what it is yet. And I'm calling it theta, and so theta IXI is the amount that is multiplied by, and if our initial 1 unit would now grow to this omega, which is just sigma theta IXI. But these are compounded over time, so the product of these is the wealth at the end of the interval. Just notation. And the idea is to first look at some idealized target. I'm going to stick to constant rebalanced portfolios still. It's possible to go beyond that, but that make it too complicated. So just pretend that we look into the future. At the very start, we say, I want to do the best I can possibly do at time t. And I decide this at time 1, and I actually know all of the gain multipliers. And then I can select the best theta. So for each time I come to, let's do it backwards. I look at this time, I get to see the result at the end of the time. I go back and I choose the values of theta, the amounts that you do in the rebalancing to do the best possible. And the thetas, I'm assuming in this case you can't short stocks. All the thetas are non-negative and they add up to 1. And so the wealth outcome, if we call that theta star, we'll call the wealth outcome phi star. And it has some interesting properties. Firstly, it beats, actually Shannon's being a bit sneaky by saying beats. He really means, sorry, Cover says, Cover really means cannot do any worse than best buy and hold. But at any rate, let's just call it beats. Why is that? Just because buy, if we decide, well, I'm only going to buy security 1 and hold it forever and not have anything else. That's just a point on the simplex that we're optimizing over. We have a lot of other points available, so we can do that. Arithmetic mean is just a point on the simplex. Geometric mean can't even be as good as that. And something that's slightly surprising, and you can see why we don't worry about generating processes. It doesn't even depend on the ordering. Remember, we just have the product of all these omegas. The omegas are going to be the same because for each theta, omega is completely defined at that time. So oddly enough, you can do them in any order. Now, Cover kind of makes a virtue of this because he says, well, let's suppose you had a stock market crash. You're still going to do just the same as if that crash was, it usually takes place over several days, right? If these days were distributed all over the rest of the place, and even though the stock market wouldn't have gone down as much, it doesn't matter, we still get the same result. And here's his algorithm. I'll come back to the integral in a moment. I was talking to Devin earlier about this, and the more modern way to think about it is the following. Let's suppose we have a bunch of experts. In this case, each expert just chooses a value of theta, and they say, right, I'm going to bet on that forever. This is my portfolio. It's going to be 1/3 Apple and a quarter BHP and so on. And then we see how well they've done. And we average over that. We choose a theta which is got by averaging over these in such a way that we give the most weight to the people who have done the best so far. It's kind of a reasonable thing to do. And it is strange because I said we don't really care about distributions, whereas this is like estimating a distribution. But it works, and the big deal about this is that the wealth that we get in this, assuming that the optimal wealth grows exponentially, that's the unattainable wealth, the target wealth, phi star. The Cover universal portfolio, which is what this is defining up here, grows basically as fast to first order in the exponent, which means that if the best possible one is growing exponentially, so is this one, which is quite surprising, because the other one was looking into the future to be able to do that well. Oh yes, so okay, then this is just to point out that this is an integral over, you know, continuously points in the simplex. So again, we're probably going to have to use Monte Carlo Markov chain or something. However, if you've only got two securities, this is quite easy to do, so that's what I've done. Well, we still have some of the properties we had before. It can be shown still to beat the geometric mean. And it still doesn't depend on the order that things were presented. We may lose the beating the arithmetic mean and beating the best buy and hold. One thing I should also say is there's a result about asymptotics. In fact, I think I've got that on the next slide. Oh yes, yeah, okay. Asymptotically, this is going to be really good. It's going to be sort of as good as the one that cheats by knowing the future. But we don't, in the version I'm showing here, we don't really have a guide as to how fast it is converging. Now, there are results that are better than this. Cover's work was done, I don't know, maybe 30 years ago, and there's been quite a lot of work done since then. But at any rate, just taking Cover's work as it stands, we're saying that the exponent of the universal portfolio is only order log t over t, worse than the exponent of the target portfolio. Oh, sorry about that. Okay, oh yes. Cover's proof is basically lots and lots of algebra and a couple of uses of the Jensen inequality. All right, here is an example. These numbers are intended to be sort of realistic now, and I've given it 5 years of pseudo equity performance. I've taken fairly typical mean and variance and fat tail, added some fat tails. Sorry, this is a rather fussy picture. Just concentrate on the green and blue dots at first. You can see these are just two different securities. And the green one is worse initially and then becomes significantly better. And then the blue one takes off like a rocket and then thrashes around like mad. The grey shading is the target portfolio, and in this simple case, it's essentially just the upper envelope of the two results. And then the universal portfolio is actually doing pretty well. You shouldn't think this shows that it will catch up on the target every time that quickly. Even that whatever 5 times 256 is, about coming up for 1,300 days, 1,300 or so bets, isn't necessarily enough. And in fact, if I run a lot of simulations on this, sometimes it definitely isn't enough. But what we've got is the universal portfolio doing surprisingly well. Oh, and this is just at the bottom here. Theta is a scalar. It's just the weight applied to the first security, and the second one is just 1 minus theta. And you can see that it never actually varies all that much from a half. It started off a half each. But it does tend to try to follow the performance. You can see here, blue is doing better, and blue is getting a heavier weight. Here, green is doing better, and green is getting 0.55. So it might mean we have to run it for 1 million steps before these things look spectacular. Okay, I mentioned an issue with Kelly earlier that we need to know enough about it to get the Kelly fraction. Well, there's an obvious thing we can do with the universal portfolio. We can just make one of the investments, say a treasury, a government treasury security, and we even just call it cash. So it has constant return. That's fine. It'll all still work, and we will get a result telling us how much to invest in cash and how much in everything else. And since both Kelly and Cover maximize the long-term growth, eventually, where eventually might be the lifetime of the universe, there should be we should get to the right Kelly fraction, and we'll need MCMC. Okay, just to get an idea of why this works, we had talked about volatility pumping earlier that Shannon did, and it's like that over short times. What you're doing with volatility pumping is you're selling if something goes up and you're buying if it goes down, which is great as long as there isn't a trend against you. In investment circles, it's called mean reversion. But it's also following trends over longer times. So this would be momentum. So it's got both momentum and mean reversion if you're into the jargon of hedge funds. And so you can see it kind of makes sense. It's used a lot more widely nowadays. They have minimax regret optimization. Instead of trying to maximize your wealth, you minimize your regret defined in some suitable way. You have a committee of experts. That's just like our guys that said, okay, this is my theta, I'll use it forever, this is my theta. And that very simple weighting scheme I had, which is just bet essentially proportionally to people's performance so far, is the easiest. There are other possibilities, and there are multiple books about this. I have some references here. I can make these available now to try and copy them. Why does this not fit onto one screen anymore? Oh well. So this is Cover's book. It was the first book, the first paper in the first edition of the Mathematical Finance Journal. But much more recently, Regret Minimization, there's a book called Prediction Learning and Games, which is about $150 now. Unfortunately, I don't think it's in the library. And so on. Okay, there's other stuff here. People might be interested. There's a book that I found which claims to have R, code in the R language for Kelly. It's quite a nice little book. I have no idea how good the code is because I didn't ever try to run it, but you can get that. Okay, and so here's the end of our syllogism. And perhaps the third item is not quite what you might have hoped for. In other words, be careful. So I think that's all. I mean, I have a little bit of time. If people are desperate for an indication of how it's proved, I'm prepared to do a very simple version of that. But I think people are getting pretty tired by now, so I'm quite happy to stop there. Attempt to answer any questions.
Thank you very much. Questions from the audience, please? Yeah.
So what this comes down to in the end is that you must rebalance your portfolio, right?
I'm sorry, could you read that again?
What this comes down to in the end is the benefits of rebalancing the portfolio, right?
Yes,
And,
yes.
And in particular ways you know, there are algorithms such as Covers algorithm which suggest you should do it. Thinking about this from like an efficient market sort of point of view, if everybody is doing this, then say in the stock market, then surely there's now a demand for the losing stocks.
You'll presumably get to the point that lots of people claimed you were at years ago, which is there's just a a small random walk because everyone is
Yeah.
behaving as if they had perfect
But I mean,
information.
So my point is that if people were doing this, whichever asset is done poorly, there's now a demand to buy it because people will be rebalancing into.
Yes, it'll move up.
into it.
Yes,
So maybe,
yes.
So maybe you don't actually have to worry.
Yeah, it's a well-known issue in investment that alpha, as they call it, this is not really alpha what we're talking about here, but ability to forecast gets eaten up very quickly as soon as a lot of people start doing it. In fact, Renaissance, probably the top current investment run by a mathematician, Simon, they actually deliberately take advantage of that. When they discover a new predictive source, a source of alpha, they then run it to capacity themselves because these are guys with tens of billions of dollars in investments. So it's not available for anyone else, and they get whatever juice is available out of it, and no one else can even see it. So absolutely, yes. It's generally the case that any kind of investment process suffers when too many people jump on the bandwagon.
Other questions, please? I think the problem is we mathematicians don't care about money.
Ah, yes, but this isn't only about money.
Well, let's change it then. The word universal is rather suggestive when you think about universal code. Does this algorithm need to, in logarithm sense, some sort of way of building universal code? If you think about it in terms of like, prediction, log prediction of somewhere in the process, if you follow this algorithm, would it be universal in the sense that one person is universal code is universal? Would it imply the same sort of thing? Yeah.
Yeah.
Of course,
Yes.
it might be interesting mathematicians.
Yes, it has potential applications in any kind of predictive process. The committee of experts idea, weather, for instance, it is rumored to be used in to some extent. But it happens that this all came out of betting. But probability theory came out of betting too. Incidentally, probability theory is a branch of information theory. It just happens that if you take the information in bits, then 2 to the minus I is a number between 0 and 1, which is called probability. So you could have started with information theory. But yeah, information theory is actually very, very interesting in general. And and if you have a pension or superannuation, you have to be interested in cash to some extent, I'm afraid, because if the guys aren't competent who are in charge of it, you're going to need to take your money away and do something yourself.
The other option is to work until you fall down. It's called the Neville model.
Right.
Anyway, if there are no further questions, thank you for attending. Thank you, Alistair, for
Thank
tonight.
Thank you, Ron.